Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Jed Kolko, who's the chief economist of Trulia, and he's an expert in the question of renting versus buying and home ownership. Jed, a real pleasure to have you.
Thanks for having me.
So if you could summarize for our listeners whether it's better to buy or whether it's better to rent, what would you suggest?
There are a lot of factors that go into the decision about renting versus buying. A lot of those factors are financial, of course, and to decide whether it makes sense to buy or to rent, you, of course, have to think about how much you're going to pay each month in terms of your monthly rent as well as the monthly mortgage payment, but there are many other factors as well. There are all the closing costs that you pay when you buy, both at the beginning and when you sell, and you also have to factor in the price appreciation that you might get when you sell your home as well. When you factor all these things into account, including how long you're going to stay put and whether you are itemizing your tax deductions, we find that nationally in the U.S., it now looks 38% cheaper to buy than to rent. But that varies a lot by local market across the country.
Mm-hmm. And based on what you're saying, this actually sounds like a rather complicated calculation.
There are a lot of steps in the calculation. The reason why you don't just want to look at the average rent and compare that to the average mortgage payment people are paying is, first of all, that leaves out a lot of the important costs and benefits of renting and buying. You want to factor in things like taxes and insurance. The other thing is that the typical unit that people buy, the typical owner-occupied unit, is a lot bigger than the typical rental unit. So you want to make sure you're doing an apples-to-apples comparison when you're comparing whether it makes more sense to buy or to rent.
That's actually interesting that you talk about the size because, you know, my day job is that I'm a financial advisor, and this question does come up a lot. And one of the issues that I'll note to people, at least in the local market where we are in Jerusalem, is that you can afford to rent a much nicer place than you can afford to buy. So there's really a quality of life difference. Do you tend to see that also in the markets that you look at?
There are big differences in the size of units. There are also differences in how well they're kept up. It also depends on the market. You know, in markets where there are a lot of regulations and in markets where there are rules around what landlords and tenants can do, you sometimes find the rental stock doesn't hold up as well as a lot of the units that are available for sale. Right now, what we're seeing in a lot of the U.S., on the flip side, is a big boom in apartment construction. So there are a lot of new rental buildings coming onto the market that will be available for rent. That means that in some markets at the high end, you can find some very nice rental units right now, but you'll pay a lot to live in them.
When you're talking about the regulations, I'm sort of reminded of this movie that must have come out 10 or 20 years ago. I think it was called Pacific Heights, about this couple that owned a property and they were renting it out, and because of all sorts of rules, it was complicated to get rid of their tenant. If you're living in a city or an area where they have such rules, does that make the price of rent go up or down?
It depends on the details of the rules. Often, regulations around rent make it cheaper for people who already have a rental unit to stay put, but it might discourage new construction or take some units off the market, so it makes rent more expensive for everybody else. One of the things that we often see is a big gap between those who have gotten into a rental place and those who are trying to find one in markets where there are a lot of regulations around rents.
Okay, so let's go back to talking about some of the ways that people look at real estate. One of the common ideas that people have is they say, you know, I'll become a landlord. I'm going to buy a property, I'll take a mortgage, and I'm going to put a renter in the property, and I'll figure it out so that the rent that I'm collecting is pretty much the amount that I need to pay my monthly mortgage payments. And then at the end of 10, 15, 20 years when the mortgage is done, well, I own a property and with no mortgage, and I didn't have to pay anything, so I had no problem from a cash flow standpoint on a monthly basis, and all I had to do was put down the money. What a great deal. Is that, in fact, a great deal?
Sometimes it works out just the way you described it, and often it doesn't. I mean, a huge factor, of course, is at the beginning what the rent versus the purchase price looks like. Right now in the U.S., rents look fairly high compared to sales prices, and we've actually seen, because of that, many investors, both large institutional investors as well as small mom and pops, buying up homes to rent them out. There are a couple big things to keep in mind, though. One is it can be a hassle to be a landlord. You could decide to pay for a management company to deal with managing that property, but either through time or money, there is a cost to being a landlord and to maintaining that property and responding to what your tenants need. But also, real estate is a less liquid investment. It's harder to get rid of quickly if you need to than lots of other kinds of investments. And if you are a landlord owning a home and renting it out in the same area where you have another home that you're living in, you could find yourself being very undiversified. If all of your assets are, say, in Jerusalem or Long Island real estate, that may be okay if you've got lots of other assets out there so that your overall portfolio is more diverse. But it's easy if you start buying up homes and renting them out and staying a landlord to have all your eggs in one local real estate basket.
I think that is a critical point people have to learn. We're talking with Jed Kolko, who's the chief economist at Trulia. He specializes in understanding the real estate market, and he's been talking to us about one of the concepts that a lot of people have, which is buy a property with a mortgage, put a renter in it, and have the rent that you collect cover the mortgage payments. One of the problems that I've often thought with this is that if you have a mortgage, often the monthly payments can be variable and can in fact go up, which seems to have been the problem in the housing bubble a few years ago, and you may not be able to raise the rent commensurate with the amount of mortgage payments. Is that a real problem that people have?
It depends on the kind of mortgage that you get. What's typical in the U.S. is the 30-year fixed-rate mortgage. And what that means is even though the mix of your mortgage payment, that is principal and interest, changes over time, the overall dollar amount of your mortgage payment doesn't. What's much more typical outside of the U.S. Are mortgages where the interest rate adjusts over time. And during the bubble in the U.S. last decade, many people did get those kinds of adjustable mortgages. And when the rate went up after introductory rate that lots of people got in the first 2 years, many people were then unable to pay that higher mortgage payment. But again, it depends on whether you've got a fixed rate or adjustable rate mortgage, and the norms are very different in different countries around the world.
Mm-hmm. Boy, it's interesting talking to you, and I don't want to put you on the spot, but many of the questions I'm asking, you're saying it depends, which I accept, and I think one of the things that I'm realizing from this is the complexity of the real estate market in different locales, and that each one is its own specialty.
Both within both local markets have prices are different levels, there's different volatility, but then when we look across countries, there are different mortgage systems, housing finance systems, that determines the types of mortgages that people typically get. There are also different tax treatments. In the U.S., the deductibility of mortgage interest and property taxes for many people lowers the cost of home ownership significantly compared to renting. But those tax rules, of course, are different in different countries.
Mm-hmm. So let's use a little bit of hindsight. A few years ago, we so quickly say, well, there was a housing bubble, and of course, a crash, and it caused all sorts of other problems. What did we learn from that? Is there something that now people can learn in order to identify a bubble as opposed to just a very strong market?
I think there were a couple of lessons that came out of last decade's housing bubble in the U.S. The first is that there were clear measures that showed that prices had gotten out of line with where they usually are historically compared to other measures like incomes and rents. We, in fact, do a quarterly bubble watch measure where we look at U.S. home prices, comparing the price level to incomes and rents to determine whether prices look overvalued or undervalued versus those fundamentals. Right now, U.S. home prices nationally look about 5% undervalued, but in some markets, such as Southern California, they look overvalued right now. Mm-hmm. I think the other lesson that came out of last decade's bubble was around the ease of getting credit in types of mortgages. And one of the policy responses that came out after the bubble and has been put in place is a new set of guidelines for what constitutes safer mortgages. So mortgages where there's no money down or your principal balance rises over time, those negative amortization mortgages. Those are all examples of the toxic mortgages that got many people in trouble last decade. And those are now outside of a new set of rules that mortgage lenders in the U.S. face when they write mortgages for borrowers.
Okay,
so that's the other lesson learned.
That kind of begs the question, so I've just got to go ahead and ask, which is, from a government point of view, it certainly would appear that the banks were giving out mortgages that were so unsecure, and they ended up getting hurt, and of course then ended up going and requiring government bailouts. Do you think it would be better for the government simply to segregate these, to tell the banks, listen, we're not going to back you up for that, make it more of a free market so that people who want to take the risk as lenders to low quality housing can do it, but it's clear they know what they're doing, as opposed to the banks who are going to have to be a little more careful because they know that the government isn't there to backstop bad loans?
Well, that's exactly the intent of some of the bills now in the U.S. Congress designed to do a major overhaul of how mortgages work in the U.S. Right now, there are some reform proposals that would shrink the government's role in the mortgage market. They basically would say that instead of guaranteeing mortgages through Fannie and Freddie, the big government-supported agencies that were big players in the mortgage market, instead the private sector would take much more of the initial risk. The reason behind these reform discussions are to get taxpayers off the hook if and when the next downturn comes. The flip side, though, of course, is if there's not as much of a government backstop as there used to be, that's going to raise the cost of borrowing. Mortgage rates are likely to be higher if the government steps back, and people have estimated rates higher by anywhere from half to a full percentage point.
It just seems fair to me. I just don't understand why the government should be protecting people who shouldn't be taking loans, or allowing folks who want to take risks with their investments, let them lend the money. I just don't understand why you and me should be on the line to bail out people just because they want to own a home that is bigger than they can really afford.
Well, there are a couple reasons why that's been the system in the U.S. One is that there have traditionally been affordable housing goals, making sure that home ownership is available to a range of groups across the country, and Fannie and Freddie and other government programs had been in place to make sure that access to housing finance remained widely available and affordable. But the other is, aside from underserved groups, there's a strong political desire in the U.S. to keep the 30-year fixed rate loan. So a long-term loan where your payment is fixed, unlike the adjustable rate loans we talked about a few minutes ago, to keep that as the centerpiece of the way people buy and finance homes. And because those aren't loans that banks want to keep on their own books, there needs to be some kind of way for banks to pass on that risk, and that requires some kind of coordination. And that's the other rationale for that government backstop.
Right.
But the reforms are really about reducing that government backstop, which again would ultimately mean taxpayers aren't as much on the hook, but getting a mortgage would cost a little bit more for everybody.
Mm-hmm. All right. Well, we'll have to come back and talk about that on a different episode, because I think that policy issue is fascinating. But we are just about out of time. Jed, tell us in the last few seconds, how can people learn more about the work that you're doing and follow you?
Come to our site, www.trulia.com. You can see our housing research on the Trends blog. And when you're talking about renting versus buying, you can actually do the math for yourself using the calculator that we have on our site. Just look for our rent versus buy calculator off our homepage.
Okay, we will put a link to that at the show notes of GoldsteinOnGelt.com. Jed Kolko, thanks so much for your time.
Thanks, Bert.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.